Gold is, to paraphrase our own work, gold is consolidating near $4,000 an ounce after a brief correction, but remains aligned with UBS's forecast of 4,200 by year end. But wait, there's more. According to UBS, falling real rates, that's happening. A weaker dollar, maybe not. Strong official demand, that's happening, could push prices toward their upside target of 4,700. You could have a $2 range in silver that's unchanged on the day with a $30 range in gold. So when there's uncertainty in the market and there's no news, gold will flatline on volatility faster than silver. Silver will attract stupidity for short time frames. It's down 30 cents now. But I mean, look, silver's down 30 cents, which is 60 basis points. Copper's down 2.5% almost, 2.4%. See that? Silver's strong right now.
Market strategist Vince Lanci explains that gold's current pause near the $4,000 level, it's healthy consolidation within an ongoing uptrend. UBS still projects a move to $4,200 by year end, with an extended upside toward $4,700 if real rates continue to fall, and official demand, led by central banks. The dollar may not weaken much, but the broader macro backdrop still favors gold's strength. Lanci contrasts gold's calm, range-bound behavior with silver's volatility, referring to it as the emotional metal. While silver can fluctuate by 30 to 60 basis points in minutes, gold absorbs uncertainty with stability, the hallmark of deep institutional confidence. Both metals, however, remain in bullish territory, with gold leading and silver quietly proving its relative strength. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Gold is, to paraphrase our own work, gold is consolidating near $4,000 an ounce after a brief correction, but remains aligned with UBS's forecast of 4,200 by year end. But wait, there's more. According to UBS, falling real rates, that's happening. A weaker dollar, maybe not. Strong official demand, that's happening, could push prices toward their upside target of 4,700. I think it's all about the rates, not the dollar and not the official demand. Just to give you a little heads up there, it's all about real rates, which means as real rates drop, monetization of debt increases, and we are on a path to that. The bank notes that 2/3 of central bank buying goes unreported. 2/3. I'm sorry, it never used to be like that. Maybe it was, and we just didn't know about it, but 2/3 of central bank buying goes unreported. So those charts that you see, this is when they bought, and now they're, since 2022, they've been buying since 2009. I'm sorry, this is just ridiculous. Aside from the fact that there's more gold being bought than you know about, what does it also say about Western institutions? That they're unreliable now. As the demand goes east, the supply goes east. We've seen that. As the supply goes east, the businesses go east. The vaults, the salesmen, the wealth managers, and as all that goes east, what happens to Western post-Bretton Woods institutions like the LBMA? They die. Like the IMF, which relies on reported data by voluntary institutions to give good information, they die. They're dying. They're unreliable. It's the mall that no one goes to anymore. All right, so rant over. That's the idea. The idea is as the East takes demand, as the East has demand, it takes supply. As it takes supply, it takes data. As it takes data, it weakens the franchise of institutions that control price in the West. It weakens the franchises that influence dollar strength. This is how price gets ported from the East, from the West to the East. Pricing power on exchanges is our most valuable asset right now when it comes to commodity prices. And commodity prices are one of the most important pillars of global dollar dominance. And as you take the demand and the supply and the data and you weaken the support structure of these institutions, the post-Bretton Woods bureaucracy is dying. IMF, World Bank, LBMA, all these things are dying. Now, they'll be replaced by the Chinese version of them. Let's be clear about that. But at least the Chinese version and the BRICS version is pro-gold right now. So we're not too biased. Anyway, back to this story. The bank notes that two-thirds of central bank buying goes unreported, rant over, reinforcing a structural bull market and framing today's consolidation as a healthy pause before gold's next advance. That's interpretation. That's our interpretation of a chart they gave. Basically, it's an analog of previous pullbacks. Jordan at the Daily Goat and I discuss these a lot. He's very big on these sort of things, but he'll probably do them for every year going back to the beginning of time. But this one is pretty good, but it's cursory. If you want the advanced stuff, talk to Jordan. Continues in the premium post. UBS asks, can gold's rally resume? The answer is yes, with 4,700 in play. And I say asterisk, if real rates keep dropping. The other stuff we know. We don't care about. We don't care about the dollar. The dollar's not a reason for gold to go up or down. Real rates are a reason. World Gold Council Gold Demand Trends report came out. Now, the World Gold Council in our small circle of gold bugs doesn't really carry a lot of weight with us because of their writing style is very muted and negative, actually. But this report is extremely important. Gold demand trends says what central banks are doing, what they intend to do. And it's really an unfiltered analysis. And when you see things like in it, like the Philippines is going to sell some gold, that dropped gold. When you see most banks are going to buy more gold next year, that rallied gold. So these trends need to be digested. And so we're going to break that down for everyone. Let's see if I can make this bigger. Oh, yeah, there you go. We're going to break this report down. There's a table of contents that we've broken out on the left. It's like the PDF thing, right? And the things that are the most important that we'll pay attention to are ETF flows. We know about them, but we want to see if they'll continue. The West, investment demand, how has it changed? Central banks, which is key, and that's what actually roiled the markets for a couple of days. I'll talk about this. This report is important. We're going to break it down for everyone.
Vince Lanci outlines that gold's current consolidation near $4,000 is not a sign of weakness, but rather part of a healthy reset within a long-term structural bull market. UBS expects prices to reach $4,200 by year-end, with the potential for $4,700 if real rates continue to fall. The real driver behind gold's strength, not the dollar. What's striking, Lanci emphasizes, is that two-thirds of central bank gold buying now goes unreported, signaling a shift in both demand and pricing power from the West to the East. As Asian institutions accumulate metal and influence, Western entities like the LBMA and IMF lose credibility and control. The era of post-Bretton Woods dominance is fading, and with it, the foundations of Western financial authority. Let's get into the interview.
I like this. This is starting to shape up the way that I think it will, and that is 4,000 is a magnet. Absent news items and absent an emboldened bullion bank cohort that will push it down, this market will find its gravitational force in it. Now, admittedly, we're at the low end of the gravitational force, but Polytrends, Sumo's product here, which I'm starting to like a lot, says between 39.52 and 40.23, I'm interpreting as take a nap. Now, my range is more like I'm not bearish until it gets below 38.85. Really, I'm probably a little bit bearisher before then. But see this area here? I'm looking at this as the range. It's going to capture us for a while. And I'm looking at this right here as the level that we have to get above, 41.60-ish. I think this seller, the BIS, has a copycat in here. Silver, a little different. Now, the volatility in silver is going to make it harder for me to make that assessment. First of all, options don't have the pull, so there's no strike right now that's going to make silver no gravitational pull on a strike. The first thing. The second thing is silver is more volatile to begin with. The third thing is silver is economically tied. So there will be people that are going to start, as time goes on, they're going to start saying, okay, let me sell some silver. Let me sell some silver. Copper's already down. Let me sell some silver. That's going to happen. So you could have a $2 range in silver that's unchanged on the day with a $30 range in gold. So when there's uncertainty in the market and there's no news, gold will flatline with volatility faster than silver. Silver will attract stupidity for short time frames. It's down 30 cents now. But I mean, look, silver's down 30 cents, which is 60 basis points. Copper's down 2.5% almost, 2.4%. See that? Silver's strong right now. Gold is down 35 basis points. Okay? Copper is down 2.4%. Silver is down 60 basis points. Genetically speaking, silver should be down 1.5 to 3 percentage points. Okay, so silver's very strong. You may not feel it today, but it is.
Analyst Vince Lanci believes gold's behavior is unfolding exactly as expected, gravitating naturally toward the $4,000 mark, which he refers to as the metal's magnet zone. In his view, this range between $950 and $4,923 reflects a balanced, consolidating market rather than weakness. Unless there's major news or a strong push from bullion banks, gold will likely oscillate quietly within this range before building momentum toward higher levels around $4,160. Silver, however, tells a different story. It's inherently more volatile and economically sensitive. Despite recent pullbacks, silver's resilience stands out. It is down just 0.6%, while copper has dropped by over 2%. Lanci views this as a hidden strength, suggesting that beneath the surface, silver remains firmly supported within a broader bullish trend. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.